Warm welcome to our session for today. As I briefly introduced you before, DECODE is the largest tech and entrepreneurship nonprofit that's co-hosted with Berkeley and Stanford. And this particular cohort here is the second cohort in the VC fellowship program, where we're predominantly bringing in folks who have on average, at least 5 to 10 years of work experience to come in and get exposure to the world of venture. Because while students are now getting unprecedented exposure to venture, there are folks who just didn't have that opportunity earlier in their career. So we really have quite a diverse cohort of people who are based in different geographic regions, who have had extensive tenures in everything from hardware, software, large companies, startup companies. Some of them are thinking about even starting their own family offices, investing, transitioning careers into venture. And so we have quite a diverse set of folks that hopefully you'll get to know better throughout this event as well. But without further ado, I would love to introduce you, Lisa, as well, because you've had such an amazing set of experiences. I mean, first of all, you've been at Top Tier Capital since founding it in 2003. So maybe I feel like I wouldn't do you justice. So maybe you could tell us a little bit more about your story and how everything came together.
Okay. Thank you for having me. And first I have to say, go Bears, right? You have to do that.
Bears.
And so when you said my journey, I thought, yes, it was a long and winding journey that probably my background doesn't fit what a lot of people have done to kind of try to get to venture, get to investing. But I won't go into that detail, but for venture capital, my journey actually began in almost 3 decades ago at Horsley Bridge Partners. And I would say it was really through serendipity, luck, and hard work that kind of got me into the industry. So we were a venture capital fund of funds. So we invested in the venture funds. And at that time, there was only probably a handful of venture capital fund of funds globally. Now, fast forward to Top Tier, you know, today there's thousands of venture capital fund of funds globally, and more being created every day. I just talked to somebody else today about a new platform, and I worked mostly in Silicon Valley in San Francisco, and Top Tier, we did primary investments into funds from emerging managers the whole way to established top tier names to co-investments. We did co-investments. Actually, we've been doing them for a decade, so long before some of the other LPs did them. And because we spun out from a firm called Paul Capital, which was known for secondary investing, we actually did secondaries from the beginning, and that was both in funds and companies. So Top Tier was a platform that mostly was focused on the US, doing venture capital, mostly early stage, some growth as the market moved. We did start investing in Asia, mostly China, in 2006. There were a number of institutional limited partners in the US that started doing that, and that was very profitable for them. And we had always had a little bit of Europe. And in 2019, Top Tier created a European-focused venture capital fund of funds. And so I kind of transitioned to my current role as partner emeritus at Top Tier while in London. So I was in our London office.
Amazing. I think it's really exciting for folks to hear how your career spanned these different perspectives, but also different geographies, because we do have folks based in different regions around the world now, some of them working remotely, some of them permanently based there. Given that we have a mix of audience, I think it would be really helpful to hear your perspectives on if there is a right time to start a career in venture. Is it beneficial for people to get into venture as early as possible, or is a mid-career switch possible after some industry experience? Love to hear your thoughts on that.
Yeah, there's no straight path. And I have people asking me all the time, how do I get in? How do I break in? How do, luck, serendipity, and hard work, like I said, helps. But if you think about venture and what it is, it's helping startup companies grow, and progress. Then having some type of operating experience, whether it be with a large company like Google or Facebook, or a smaller company, because knowing how to be in a startup, which has a very different experience than being at a very large company, whether that be a tech company or any company. And that type of experience is very valuable. So it doesn't matter when you want to get in or when you get in, it's having that passion to get in and having the networks and some of the context to understand what it is to be in this world of startups and tech investing.
And actually on that network piece, building on top of that a little bit more, one of the common questions that we also talk about in the cohort is obviously a lot of them have had depth of industry experience elsewhere, like if they were working hardware at Apple or, they were working in software at Amazon and have switched over to earlier startups, but now are thinking about, well, I don't know if I have the meaningful connections to help people or add value to startups as much as they otherwise would have. Are there some ways that newcomers can start to provide value early and help them build their reputation faster?
Yeah, I mean, networking is everything. And, I would turn that question around a little bit and say, what does anybody have to do to be value add to whatever it is, a company, a project? And I think you really have to be a good listener. You have to be realistic about your value add, what you can bring to the table. And then I think you have to make sure you do what you say you're going to do, right? But you have to really be creative too. I mean, you might be able to be introducing people to your network, some new employees, for example, or a product person or somebody that could maybe advise them. You're not necessarily going to be able to introduce them to their next Sequoia, a partner at Sequoia or their next big corporate customer. But there are a lot of things you can do. You could help them think about their product or their product market fit and help review, business strategies or be a sounding board. You could be a product, somebody that really is a cheerleader for the product, whether that be on social media or some other way. So there are ways to add value that aren't necessarily obvious.
I think that's really helpful. And by the way, if throughout the event, if anyone has a question and you want to jump in, please feel free to either ping it in chat or just turn on video and or raise your hand, and we'll be sure to call on you, because I want to make sure that this is as interactive as possible. And Lisa, obviously you've given tremendous advice to a lot of emerging managers, even well-established mature funds in the space, given that you've invested in so many venture funds. Be really curious to hear from your perspective, kind of an overview for what a career progression in a venture fund might look like, because it's very different than if you worked at a large tech company where some of our fellows have, where the career progression is more clear. So in a venture world, how do you celebrate that progression, and how do you maintain or obtain that necessary skill set and gain that as quickly as possible?
Yeah, I would first say as an LP, it's much more fun to work with emerging managers who actually really need a lot of guidance and a lot of just somebody to listen to them, a sounding board, a true advisor to them. So I've always enjoyed working with the emerging managers, but established managers, like you say, need help as well. But as far as an individual with their career progression, you really need to think about what, how passionate are you about the business? How passionate are you about what the business strategy and the future business strategy is for that firm? How are you on a team? How engaged are you? Because there isn't, you have to sell 5 widgets and then you're going to get promoted, right? I mean, you become an investor traditionally through a mentorship, that it was always kind of a mentorship position when you got a job as a venture fund as an analyst or as a junior investor or a junior partner, whatever your role is going to be. And you just learn. And a lot of that learning is listening and asking questions. But I think to understand your career progression, not just in venture, but a lot of places, I think you don't want to necessarily be always looking on the outside to see what all your peers are doing. You need to understand in the context of the firm you're working in and have the conversations and have the frank conversations of what is the next step and the next role and what is necessary. I mean, there was one particular fund I'll never forget. They were actually a fund in China, and they were like, we are very clear what you need to do to be promoted to partner here. You need to return $100 million to the fund on a realized return basis. There was no question. That was dollars delivered back, period. That's really not the way the business works mostly. It's how are you developing as an investor? What's your deal flow look like? How are you engaging in the community? What's your reputation in the community? All those things are really important to think about as you think about your career progression. And I know it's hard to be patient with those things. And when you're an established firm, it might even be harder because there's more individuals, positioning to move up in their career path. So you always do have to have some, maybe sometimes major dose of patience.
And I'm sure, Lisa, you share this with folks all the time that, any typical fund lasts on average 10 years. So it does require a lot of patience to see the results come by. And I think actually your answers in kind of the last two tied together as well, in that hopefully this fellowship is building or starting to build a meaningful base of a foundation for everyone to connect with each other. I mean, you as each other are all valuable connections you could introduce for someone else, like an entrepreneur who's looking for help. But then you want to build on that to figure out in the long term, what are some of the ways in which you can continue to add value? And on that, one of the questions that we oftentimes then get is, what are your thoughts on specialization? And when is the right time to think about being very niche as opposed to being sector agnostic or being very generalist?
Yeah, I mean, there is a notion of being a good stock picker, which that's what we use internally. It just means you're a good investor, and some people are going to be good investors and some people aren't. And it's okay that you're not a good investor, but you shouldn't be in an investment role then. There are other roles within the firm that might better suit you. So first of all, you need to be a good investor. But I think in today's world, specialization is best and required. In the early days of VC, people were generalists, and actually they weren't even very technical. A lot of people had MBAs, and that was their career path, but those days are long gone. And I think the more specialized you can be, the more of a go-to person you can be. I think the easier it will be to get on the cap table for a company. And some of that is because you're going to be able to put their business in context and be able to add value much quicker than you would if an entrepreneur has to come in and explain what they do. You're not going to resonate as much. But if you already know the sector in which, and it could be as broad as fintech or something, but if you already know the sector and the players and the customers and how this business would fit, I think you're going to be much more value add. And also remember that times will change. So while, the new thing is crypto, it could be something else in the future, right? So you always have to continuously be learning, and you might be changing what your expertise is in, but dig deep, because you'd be surprised on what type of reputation you can you can build by being a thought leader in a particular area.
And following up on that a bit more, when you talk about a thought leader, are there funds that you interacted with where you felt like they claimed to be a thought leader, but then through other metrics you discovered they weren't, or vice versa, they didn't say that they were a thought leader, but then you discovered that they were? And what are some kind of the best practices or things to avoid in that space there?
Yeah. Well, I haven't had a lot of the former because generally people don't do that. And I'm not technical enough that I'd probably be able to figure out they really don't know the details of that. But I think when, especially for new funds, first-time funds, maybe solo GP funds, I'm always trying to tease out what are they doing that's different? Why would we invest in this particular fund versus everything else that's on our desk or has come through? And that's, you know, that's something that I always aim to do. And so I'm often, you know, telling people, so really this is, you have this that nobody else has, or you do this that, you know, really is the overriding kernel to your investing activity. And so I sometimes have to do that with people as I'm advising them.
That's super helpful. In fact, Stephen asked a great question that builds on top of this thread as well. He comes from a management consulting background, and he talks about how in consulting, there are kind of two types of partners or principals. One is the subject matter expert, and the second kind is kind of the rainmaker. Curious how you would characterize perhaps generally different tracks or personas in VC, unless it really is a game of just achieving 100 million in results.
Yeah. I will say that once you are at a partner level in a fund, you really need to be that rainmaker. I mean, you always need to be raising capital, and you always need to be out thinking about investors and building the capital base. So I think of building the capital base as the rainmaker, and those people are really important. It might not be everyone at the firm. Some partners might gravitate towards that more than others, but in a lot of ways, everybody at the senior level is responsible for that. The subject matter expert ends up being more, you know, like on the investment side. And so it really isn't a lot. It's not, these firms are not really like consulting firms, because I understand what you mean. Like, you know, you have salespeople and you have investors. And a big organization like Adam Street, the fund of fund, I mean, they have people that are in the IR department. All they do is raise funds, and then they have people that invest, and never the two shall meet. But I think a lot of times it's depending on the size of the firm and really the agreement between the partners. You know, what is the expectations of your partners for what you're doing? How deep are you supposed to be the sector expert, you know, and that everybody goes to, versus also have the ability to bring in new investors?
Yeah, it sounds like really complementary skill sets, assuming that you're not a solo GP. You really do need a good balance. And that actually leads into another top question that we get from fellows a lot, because a lot of them are thinking about, do I start my own fund? Do I join a larger fund? Do I join a smaller emerging fund? What are the different considerations there?
Yeah, and of course you have to look deep into your, you know, your own character and say, what am I going to be happiest? What am I going to be the most successful? What really fits my personality type? And don't try to say, well, I should go out on my own because other people are telling me, or I really want to go out on my own, but everybody says I should join, you know, Lightspeed because they gave me an offer, you know, whatever that is. So really you need to be true to yourself and what you want. And of course, there's pros and cons to both, you know, I mean, to all three. I mean, the big funds are well established, and you probably never have to touch a fundraising. You know, the money is just there, and off you go, and you're an investor. But you also have to deal with all the baggage and the legacy, and, you know, the politics, because every firm has a way of operating, and so you have to be able to navigate that, and some are worse than others, and some people can navigate that well, and some people just kind of duck and hide under it and can actually operate well in a large organization. The solo GP, side, you're really an entrepreneur and you're really a lone wolf. And there are a number of, there's somebody recently that keeps trying to build a team and they're really a lone wolf, and they really need to be the sole GP and have a bunch of deal doers under them. I hope they learn that, but so that's a certain type of person. And then a small fund, can be the best of both worlds though, right? Because you have a small team, maybe if you even start together, and you can outsource some things, drive your own destiny, set things up the way you want. So there's a lot of attraction to having a small 2 or 3 person new fund today.
That makes a lot of sense, especially because I think there's unprecedented access to capital, even for folks who are very underrepresented otherwise in the industry, to be able to identify a unique area and do something new. So hopefully that's encouraging news for everyone that's here. And whether you end up being on a small team or if you end up being a solo GP, what are some of the common mistakes that you often see in terms of inefficient use of time, or even just advice around low-hanging fruits that they should just nail it correctly the first time around?
Yeah, I think you really need to think about, continuing to build your network in the entrepreneur community, in the VC community for co-investors, and your brand. And for small funds and solo GPs, almost everything else can be outsourced. To be honest, today, I mean, this did not exist years ago, but you can outsource the back office, the reporting, the compliance. I mean, even some, HR functionality and things like that. So it's great that you can outsource, but you can't outsource your relationship with the investors and your need to continue to raise capital. So your LP relationships are very, very important. And then continuing to build that network, because you're raising money and then you don't have time to really do your deals and deal sourcing and stuff. So somehow you really have to balance that. And that's why often inside these partnerships, I work with a partnership that there's 4 GPs. They actually met at university and they're on their probably 4th or 5th fund now, so doing very well. But one of the people is really the LP relationship person. Doesn't mean he's the only one that does the fundraising and stuff, but they've really said, okay, you do that. And it works. It's not that the others don't know the LPs or that there is an interaction, but that works for him. But he also does deals too. But the LP relationship part of it, he's kind of raised his hand and taken on, and it works for them.
And speaking of these complementary skill sets, it sounds like unless you're of the personality where you have to be a lone wolf, it sounds like figuring out what you're good at, what you enjoy doing, and then find people who are good at filling in the blanks of what you don't have. And speaking of that, of course, Lisa, you mentioned there's a deal sourcing piece and being a good stock picker, figuring out what startups to work with. And then there's the LP relationship piece. What are some of these other big pieces that you think people can start to reflect on and think about as honing in their skill sets on in the long term?
Yeah, it's thinking about, once you're really in the business, it's the platform development, right? It's how are we going to set our culture, and how are we going to make sure that is really ingrained from day one? How are we going to build our team? How are we going to set up our ability to promote and mentor individuals? How are we going to determine what the next fund strategy is and the size of that? Are we going to have advisors on our team? Are we going to do this internally? I mean, I think there's a lot of just firm and platform development that continually needs to take place. And because you're building, most institutional investors don't just want to invest in a one-off fund. They want to invest in multiple funds from a platform. So they want to back a platform that has a unique opportunity that they're going after, wholeheartedly, and that they can see that there is a path of longevity to this, not just a one-off investment.
Mm. And relating this also to kind of some of our conversation earlier, when you reflect back on all of these funds that you've invested in, mentored, advised, and worked with, are there a couple of examples that really stand out to you as ones who have really gotten this right, where, they started, were specialized in one area that was very different, and then over time, they built out this comprehensive strategy and platform that blossomed into its own thing?
Yeah. We invested in a fund. We had a program that we called Alpha Managers, which were smaller, newer funds, and it was mostly smaller was the key there. And there was a fund that was focused on enterprise seed. And this is quite a number of years ago. So that was quite unique at the time where we started investing. And because they had had some small portfolios before that, and had some actually family office investors before that, there was some, let's just call it hair on the on the kind of prior fund, the way it was constructed, that we had to really help them with, and help them construct something that could attract institutional LPs. And some of that, I know I'm being a little bit vague, but some of it is that sometimes you have different economic, deals with certain people because they put you in business or this and that. And that happened more in the past than it does today. But, you need to really think about, how are we going to make this institutionalized where others will be able to write, a check to it. And so we've helped people think through that. We've helped them think through the size and how they're going to grow the firm, how their investment strategy, the parameters that were presented, often they do change, but they need to grow in such a way that is much more natural and not, all of a sudden we're doing something out of left field, right? Because people don't like that. Investors won't like that. So it's like, okay, you're doing this type of investing. And if you maybe just go a little bit earlier, or maybe change the geography or expand the geography, that's going to be okay. But certain other things are going to just be too way off strategy. So we've helped people shape strategy. We often act as, if you're an early LP in a fund, you're also actually acting as not only a reference, but helping with their fundraise, to help them think through who are other LPs that would be like-minded LPs. We share diligence sometimes with our peer LPs if they want us to, just to say, hey, we did this fund, we can share some of our material if you want, but we do want them to be successful. So we help them think through building their LP base as well. But, we've had to restructure GPs. We've had to purchase investments, from GPs that were shutting down funds, which is good because we're in the secondary business. But there's a lot of, even though you're a limited partner, there's a true partnership with some of these relationships that we have, because obviously if they're successful, you're successful too. And that's the end goal for everyone. And you get pretty deep with certain people. But I always tell my friends, like, being an LP and an investor in anything, you want to be certainly deep and have a deep relationship, but not too deep that you can't fire them, right? Like you sometimes you have to say no to the next fund if it doesn't fit, or if the returns aren't keeping up with other returns you have in your portfolio. And so there's a fine line to walk in that way as well.
That's really helpful. I think one of the top takeaways is definitely how do you become a fund that can take on institutional investors? Because a startup that's in the very early days, in analogy, is just like a startup fund in the early days. But in order for it to take on institutional investors, there's a set number of best practices to follow. And if we were to zoom in on kind of the latter part of what you're sharing, which is really thinking about the fund strategy in the long term. If we were to zoom in on that, I know one of the top things you mentioned is differentiation. How are you different from everyone else who's trying to raise at the time? Are there any stories that come to mind where you came across a fund where you're like, wow, this is totally different? And the story is told in such a tight way that you're like, I get why this is different.
Yeah, every once in a while. And I have to tell you, it doesn't happen very often. I mean, I, I've spent the last couple years doing kind of reviews of pitch decks for different events where people are going to be chosen to present, for example. And I'm there with a handful of other LPs, and these are always different people because I've done it for a number of different organizations. And so often, we all just go, it just all looked the same, it was just more of the same. And that's why we say it is just important to be able to somehow come up with something you're doing differently, whether it be your source of deals or the way you execute deals, or it's no longer geography or sector, because once a sector is attractive, everybody, there's a lot more people that are raising funds around it. But there was once a fund that came in and they were doing like digital therapeutics and digital healthcare. And once again, today, this sounds like, yeah, so what? That's what everybody's doing. But it was the first time. And then they were involved with the first company that got approved by the FDA as a digital therapy too. So every once in a while, somebody comes in and it's something that's really you haven't heard before. It's a story you haven't heard. But what really resonates with investors is, in the easiest sense, whether you check a box that they're looking for. For example, all of a sudden I want to invest in 5 crypto funds, or I want 3 digital health funds, or whatever that is. Now, this doesn't happen very often, but if that happens, and that's what you're raising, and you can really show that you have a unique strategy and deal flow, and you're co-investing along with the top players and such, you can kind of get whittled down as being unique in somebody that they're really going to seriously consider. But most of the time, that's not the case. And so what is your elevator pitch? How would what sticks with them where they're like, yeah, there's a lot of funds we're getting, but this thing, I still remember it. It's still different. And then you have to continuously deliver that message. So there's a uniqueness and a message that continuously gets delivered and repeated and reinforced. And that is helpful. It just one thing kind of leads to the other. And that is one way to show that differentiation. But it's hard. I get it. It's hard. But you can, I do this with people all the time. I just try to talk to them and try to help them understand maybe what's different, or how to present themselves. So up front, there's kind of a real kind of hook that people will want to see, because they think it will be a successful fund and they'll be able to make a good return.
Absolutely. A lot of the work that they do as part of this fellowship is also thinking about what their own unique investment thesis might look like, and put that together, whether they're joining a fund or they are starting their own. And I think it's helpful to continue to think about that piece. I see that we also have another question. You mentioned about the digital therapeutics piece, even though it could be a new story, but the path to commercialization could be unknown. That's a great question. How do you navigate the decision-making in such a scenario where you're so new, but then it's not a proven path to success?
Yeah, that's a great question. And you see this often in groups that are doing really, really early stage tech, right? So something like some breakthrough technologies, and they're getting a lot of stuff out of university research. And it's like, that's great, but what about commercialization? And we did a fund that was investing in the ability to take research and commercialize it, but they had proven experience doing that in the past, right? So we could look at prior investments that they did, or prior experience and affiliation they had in the commercial, in making sure that it's commercial before they invested. What is the process of doing that? And this particular fund, interestingly enough, did a lot of work, years of work, before they actually made the investment, because they were making sure that it would be commercial and that there would be buyers and acquirers and all of those things. So, and that's not for the faint of heart as an investor to do those kind of things, because they are so new, and you are betting that there will be, the buyers will be there. But if you're investing behind somebody who's done it before, that, you can feel some level of comfort.
And certainly encourage everyone to continue to put any questions in the chat. But if we were to take a little step back from what we've spoken about so far, I think we've really dove deep into VC as an industry. And I know a lot of what we talk about is, whether it's featured in the media or in social media, VC seems to just generally be a very glamorous, prestigious industry, at least in recent times. And I know a lot of our fellows are curious, what are some of the surprisingly unknown things that may be kind of the dark and ugly side, so to speak, that most people don't realize early enough?
Yeah, well, it's been a really good market, as we all know. And I will confirm and tell you that it is not as easy as it looks today. The exit valuations have been incredible. And these companies are huge. So I think that is something that will continue. However, there's so many companies that get funded that probably wouldn't get funded in a different market. And very few people investing today, to be honest, have ever had to write down investments, write off investments, really manage the reserves in such a way that they know they can't raise a side opportunity fund, so they have to not participate in the next round, and move the reserves around in the portfolio to only a handful of companies that they really think have the best shot at delivering a large return and really creating a large company. And so there's a lot of activity that happens when there's a downturn that people, unless you experience it, it's hard to believe. And there's been people like me that have gone through these 3 decades, so multiple cycles, and we sound just like we don't get it, or we're crying wolf or something. But it can be a very difficult time. I mean, there are funds that were 10 cents on the dollar, and that's what they delivered, that were by very, very prestigious top funds. So it's just not as easy as it looks, and there could be very difficult times ahead.
And I think this is also where the patience piece comes in and the long-term commitment piece comes in. Right. And if we were combining these things a little bit for folks who are in full-time kind of roles now, where they're not sure whether or not this is the right time, are there opportunities to get involved, say, as a scout or a venture partner or an operating partner without having to leave their full-time jobs? And in your experience, what does being a scout versus a venture partner versus an operating partner and all of these other titles even mean?
Yeah. So I think scouts are brilliant. I think this is a brilliant thing. God bless Sequoia. They're always doing something, very, very creative and forward thinking. And now a lot of people have scouts. And I think if you can be a scout for a fund, that is an amazing foot in the door of understanding what it is to be managing other people's capital. So to be given capital from someone that you're kind of on the hook for, and that you're creating your track record with. And so generally, I think everybody knows what a scout is, that the fund gives you some capital and to make investments, and there's probably some parameters around there, some expectations. And I think that's brilliant. There are a number of other kind of titles and names inside firms, and I'll try to demystify a little bit about that. One is an EIR. That's another thing, an entrepreneur in residence. You didn't mention that, Shu, but this is often a serial entrepreneur that has sold their company that now decides to sit back inside a venture fund. And generally, they're expected to start a new company, and the fund may or may not invest. So it just gives them the ability to sit in a creative place, to participate in the meetings, to be in the flow, right? And to just, have a team of people to kind of bounce ideas off of. So EIRs are a great role, but looking at it from an investor point of view, an LP point of view, we just expect those individuals to add some value because of what they know, their sector knowledge and their relationships and stuff, but not be a go forward investing partner at the firm. So that's an EIR. Operating partners are generally not investors. So if you're brought in as an operating partner, generally what you're doing is you're operating the venture fund's back office. So you're doing finance, legal, compliance, etc. That you're not brought in to help operate the companies or something. So you're operating the funds. That does usually not lead to an investor role. So that's a different, if you want to be in the business and you like operations, but you're not an investor type, then an operating role is great. And you can get involved with business strategy, and you get carry, and you can be an important partner in the firm. So that could be an interesting role. Venture partners and advisors, I'm going to put those together because they're similar. They can be full-time or part-time, and they are different in the way they're described or utilized in each firm, but generally they're helping with investments. So these are investment people. Often a venture partner is either on their way to be a general partner, so they're being tried out, or there's someone like me who was winding down. I'm a partner emeritus now, but sometimes people call them venture partners because they're, so if you're coming up in your career or down, you could be a venture partner. And advisors are really what it sounds like. I mean, there's someone who might get involved with business strategy. They might even be on the investment committee, but they're more, and it could be short-term or long-term, but they're really advising the general partners because they have some expertise that is thought to be helpful. And all of those are good ways to get involved with a fund, for sure.
It's a super helpful overview. And actually, I think there's a couple of questions in chat. And if it's okay, we'll come right back to it, because there's one more question that I know a lot of the fellows wanted to ask, which is, what are your thoughts on how you think about the venture space will evolve? We talked a little about the macro uncertainties and just having had such a huge surge of entrepreneurs and funds and emerging managers and capital, everything in the startup ecosystem. Is this leading up to another bubble? Is this similar to patterns you've seen before? Curious to hear your thoughts. And it kind of relates to Samantha's question as well. If you feel like if you could change something about the VC sector today that would benefit the future, what would that be?
Oh, wow, that's a good question. I could change something about the VC sector today, benefit the future. Yeah, I mean, it's probably the hype, um, because it's a business, it's a difficult business, it's an important business. I'm a long-term bull on venture capital and what it does globally. You know, it is the capital engine that funds innovation, right? And I mean, how could you not be, behind that? And I've been blessed to have a long career and very grateful to have been part of that over the last 3 decades. But I think the quickness of what people expect in venture capital, I think, can be really problematic. And, to who gets in, maybe some shortcuts that are taken, because building a business is hard and it takes a long time. And I think you really want to have a long-term view of it. And I think today it just looks too easy and there's too many people with shorter term views. Yeah.
Yeah, and that's a real challenge. I've gotten a couple of DMs with follow-ups as well because it seems like everyone's accustomed to much shorter cycles. So I was reading through some of the direct messages as well, where people are saying that, well, with such short cycles, that's not long-term sustainable. So what are some best practices that we can adopt now that might be helpful?
Well, everybody can slow down. I mean, you can always slow down. Somebody told me once, and this seems simple, but it actually kind of relieves you. You can't be in every good deal, but every deal you do better be good. So it means you just don't think, oh, all right, that looks good, or so-and-so's in that, so I got to get in that and I got to do that, right? You could just be really disciplined. And it's hard. And you're going to have that, what do they call it, anti-portfolio, where you could have done this and that and this and that, and everybody has one. And often that portfolio is better in some ways because it's bigger. It's as if you would do everything, but you can't do everything. You can't make every investment. So the cycles are fast, and it's because the ability to create a company and spin it up and get real revenues and create value, that time has compressed. And that's good. The time and the cost has compressed. That's good. But as we all know, then there's the building of a good long-term business. And that's when you start talking about the culture and, the future, and how you manage that growth and the customer acquisition process and the product extensions and the new products. I mean, it just gets much more strategic on, what is it, who are we, and what are we going to be in the future. But I agree. I mean, the fund cycles, they were 3 and 4 years. And then during the dot-com bust, they were 9 months, and that turned out really, really bad. It turned out really bad for a lot of reasons. One, all the companies were founded at the same time. It cost a ton to spin them up because they were telecom businesses, and then they went to zero. So that, and those are those funds that were like 10 cents on the dollar. That was horrible. I don't really see that happening as much, but is there a place for all these companies, really? You get 10 of these and 50 of these, and so there aren't going to be 10 winners in all of these spaces. And that really hasn't played out yet, I feel.
Yeah, absolutely. And I know Yasmin's question is zooming in on a little bit more specific to Web3. Any thoughts on the Web3 bubble, in quotes, and similarities to the dot-com boom that you've seen?
Yeah, you know, what exactly is Web3? You could ask. Because a lot of times people just put these terminologies out and it's like, what exactly are you doing? But I think there'll be a lot of companies that are going to go to zero. And I don't really think it's similar to the .com, because a lot of these are companies generating revenues, or their tokens, and but some of these tokens, they're going to be used and have value, and then they're not. People are going to move on to the next thing. So if we're talking specifically about that, I think there could be a lot of zeros in those different kind of token-based businesses that are being created.
Yeah, absolutely. I know we have kind of last 10 minutes left. If anyone else has any questions, please feel free to ask your question directly as well. So instead of putting it in chat, you're welcome to just put your hand up and ask the question directly and introduce yourself as well. And I guess as anyone is gearing up to ask any questions, Lisa would also love to leave some specific action steps for our fellows going forward. Are there any best practices that they can start to develop a habit for now that is going to be long-term beneficial, whether it's writing on a regular basis, hosting conversations, being helpful to other people, making intros? If you feel like there are a couple that are good takeaways for people to walk away and start adopting day to day, that'd be really helpful to know.
Yeah, all of the above, but there's only so much time in the day. So, I would say be good to yourself, right? Make sure you leave time for yourself, and think about your health and your families. Those are very, very important, to be a whole person. And, I said before, be a good listener, do what you say you're going to do. You do have to think about yourself as a brand, and you do want to put yourself, be intentional about how you appear and what you focus on. I think that's going to be really important, because there's so much you can do and get distracted with. And it's always about keeping the noise out and the kind of core, as a guide.
That's actually such a great piece of advice, Lisa. I don't think I fully appreciated this advice until more conversations recently, where I've been talking to a lot of peers, and there's a lot of other fellow GPs that have been, on fund 2, 3, 4, 5. And a lot of the times we've recently been talking about how strategy is deciding what you're not going to do, because you only have so many hours in a day. So being really, really disciplined about where you're spending time, where your focus is, it's harder than it sounds.
No is the hardest word in the world, at least for me, because I like to be helpful. I like to meet people and share, my experiences, and if they can, hoping that you'll glean something from it. But I'm learning much more how to say no and make sure I save the time for me and the things that really make me happy as well. Because we all know when you're not your best self, you're not bringing your best self to anything you're doing. And so it really has to be kind of priority number one for you.
And actually, a great follow-up from David. He was asking,
just
how do you
say
say
no? Remember that good old campaign? I think what you need to do is, sometimes I can say no when somebody asks me, because I just say, I don't think I can be helpful, or I don't think I can give you the focus that your situation needs. But other times I actually go away and I just see what it feels like to me. And if it feels good and I'm excited, and then I think, yeah, I'm going to do this. But if I have doubts and don't really want to do it, then I come back, and say, as nicely and is accommodating, and if I can offer any other help or connect them with anybody else or whatever it might be, but I've gotten much better at saying no.
We also do have a question from Ting. What do you think of investment opportunities in digital currencies look like now, especially with governments such as US and China paying attention?
Yeah, I think, this is all going to be regulated. Everybody expected that. And actually, I think most people want it. And so if you're following the way the regulatory rules look like they're shaping and have advisors or access to that conversation and the experts in that field, I think you're going to be fine. And I think investors will still be comfortable participating. I mean, when crypto started appearing in our venture portfolios, probably 5 years ago, maybe a little bit before, we were all the institutional investors were like, oh my gosh, what are we going to do? And then the auditors, they wouldn't give you a clean audit because they couldn't prove it wasn't even the valuation, it was the existence, right? I mean, you think way early on, and everybody was like, oh no, but we think we can make money, but do we really want this in our portfolio? And but I don't see this going away, and I don't think it should go away. I think it's a really great innovation and really useful to a number of businesses. So I think people will still want to invest behind it. But yeah, China, the US, I mean, all kinds of governments are looking at it. And the ones that don't tax it now, we'll see if they continue to not tax it, because that's another thing. I mean, there's some areas of the world that aren't taxing gains and on that.
Yeah, I've gotten a couple more questions since, but I think the best summary in the interest of time is the world of VC is filled with opportunity, and a lot of people are learning about VC for the first time. And so are there better ways to explore this opportunity, whether it's directly cutting a check and writing investment into one or a few direct investments? Is it being part of a SPV and some sort of syndicate? Is it even investing into a fund and exploring role of things like venture partners or scouts? What would you recommend, or is it all of the above?
Yeah, what you don't want to do is invest in the first thing that comes by. So if you have the ability to look at deal flow, look at 25 deals before you make an investment, and take some of your own capital, or maybe your family, although I don't recommend that, or somebody, you could do it together and have a little pool of capital to invest. But I think the way to really get him, the only way you can have the experience is to actually do it yourself. And whether that's investing in funds, but the only way I'd invest in a fund, it's less risky, but you also want to make sure you have the relationship and access that you can learn also from that fund. Or figure out, there's many groups of angel investors. Join one of those and start, going to their pitch events, and then start maybe writing your own checks. But like everything, you really have to do it to fully understand what it means to make that decision, to write that check, to fill out those documents. And to actually have that experience.
Absolutely. I think this last piece is so important, because despite venture sounding glamorous, when you look at the returns, it is the hard work day to day. So as Lisa's mentioned and shared with us a couple times, it is the luck, the serendipity, but it's a lot of hard work that goes in. So hopefully, at least in this fellowship, I mean, Gerald, David, Yasmin, and the whole team has been doing a really great job of hopefully giving you weekly, regular exposure to a ton of deals. And that's something that you'll continue to do. So with the more stuff that you see, then you're a better judge of whether or not that is a good investment opportunity. And hopefully you'll all have all of these great opportunities to then plug into the venture world. And so, Lisa, I'm sure you'll see a budding generation of new investors coming out of this fellowship session as well. And for that, we're really grateful for you spending time with us. I think we should give Lisa a huge round of applause. Hopefully we're not going to cancel each other out, but you'll see all of our claps.
It was nice to see you all. And I hope I was helpful. And I see some of you already reaching out over LinkedIn, so I will get through those and accept the connection.
Tremendously helpful. Thank you so much, Lisa, and hope you have a great rest of the evening.
Thank you. You too. Bye.
Take care. Thanks, everyone.